Hi, today is the 11th of April and let's talk about the markets. Last few days, in fact almost the last 10 to 12 days, the market has been extremely volatile. The market, if you see the Nifty chart, you will see a white candle followed by a black candle followed by another white candle and so on. And this kind of market has created a lot of whipsaws and has hit stops on both sides and led to trading losses for a large percentage of traders, including ourselves. So this kind of volatility is unprecedented. But how do you deal with volatility? That is what we are going to talk about today, which should come under the general principles of trading the markets. So the way to deal with volatility is with proper money management, proper stop loss placement. Like when you know the volatility is going to be high, your stops would need to be wider, and then the right psychology. We are going to talk about psychology mostly in this section. The best work on trading psychology, most of you know, is by Mark Douglas, and this is a beautiful book which all traders should read, The Disciplined Trader. And the more number of times you read this, the better your trading will become. So when you trade, what is the assumption that you do? When you buy a stock, is your assumption that it's going to go up by 20%? No. Our assumption is based on probabilities, that the probability of it going up is higher than the probability of it going down or remaining at the same price. So we trade probabilities, and the probabilities are obviously not certainties, and that is why stop loss placements are important. The other thing is that you should always try to go and take high probability trade setups. So because that is how you are going to make profit in the long run. Suppose you were to identify your objectives of a trade. What is your objectives? But first, let us talk about probabilities. Mark Douglas said that if you flip a coin 1000 times, it would turn out that 50% of the times it will be heads and 50% it will be tails. So that would be the overall outcome of that kind of system. But the point is that if you just do a flip of 10 flips, it is possible that it may come heads, 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 heads for 6 times, 7 times. That does not mean that it's going to come heads for all the 10 times. Therefore, that is where the probability kicks in. That you know that the probability of this random flip of a coin is 50-50, and therefore, similarly, in a system where the probability of a winning trade is 60:40, you can get 10 trades in a row which are losing. And if you were to only look at those 10 trades, you would be extremely disturbed that what is happening. But that is not the way to do it. You have to look at the whole system over a large sample size of trades. And when volatility strikes, we see that our stop loss gets hit again and again and again. And that is where we have to think in probabilities again. So once you have a system which has an edge, and the edge is what takes you to a higher probability trade. I am not saying a winning trade all the time, no. It is a higher probability trade that you would win. So what is the edge? So let us look at an example. Now this is a chart of the hourly Tata Motors. As you can see, the trend is up. This you can see very clearly by the 20 period moving average. Now one kind of edge is to trade with the trend. If you just do that, your chances of winning are going to be more than the chances of losing. And therefore, suppose you were to go and short sell it here, that is falling, or here, or here, it's likely that you are not going to make too much of money, and it is more likely that you are going to be stopped out. Whereas if you trade with a trend and buy on all declines, then your chances of going into profits are more. So this is the edge which will give you a better chance of winning, and therefore the probability will be in your favor. You have to design your trading plan as per your objectives. Obviously, the chances of your risk reward has to be more than 1:2, and depends on what your objective is. In our objective for our trading on Elliott wave based models is to follow a trend, and therefore we aim for at least a 1:4 or to a 1:6 risk reward. The downside of this is that quite often the reward is not reached or the target is not reached, and the stock moves in your direction and then stock comes back and hits your stop. That happens, and therefore we are okay with it, because we know that when it does go up and hits our first or second target, it will take care of all the small stops that have been hit. As somebody has said, the trading is a 80-20 rule. 80% of your profits will come from 20% of your trades, and therefore whenever you see that you will have stop loss hits on a large number of trades, or you would come out break even almost in 80%, but the 20% which will go and make the winning mark will more than make up for all these small losses or break even trades. So this is how your trading plan needs to be organized, depending on your objectives, depending on your time frame, and so on. And finally, when you have all this in place, you then come to dealing with emotions. Trading elicits all kinds of emotions, and the two opposite emotions in trading is when everything is going right for you, you are on a winning cycle after winning trade after winning trade. What happens? You go for euphoria. In euphoria, it is a state where nothing seems to go wrong and all risk management seems to be unnecessary. So that is the one aspect of trading, or the one side of it. And the other is when there is everything going wrong and there is panic and fear. Here, how often happens that when there is a sudden market move in a direction opposite to your direction, opposite to your position, you panic and you close out all your positions. We have done that ourselves, but we have to understand that quite often there is a movement in the market, sudden move in the market, but that move may not involve all your positions. It may involve just the index or a part of the index, and therefore a generalized panic reaction is unwarranted and leads to adverse results. So these are the two things which uncontrolled euphoria or uncontrolled fear, which create a lot of problems. So the right way to deal with it is to recognize the emotion, understand, see, feel the fear, see that there is fear, see that there is panic, and do not try to analyze why there is fear. Do not try to find out why there is fear. Do not try to find a solution to the fear. Just accept that there is this emotion. And once you accept the emotion and do not try to run away from it, and in fact just accept it and you know that it is yours, the emotion will lose its control over you. and you would then be going back to your basic, going back to your trading methods, going back to thinking in probabilities. You will not be completely immobilized. You will remember the big picture. You will know that even though there is a big drawdown, you will know that there are a lot of losses, but you will know that those are all part of the game, and you will not lose your balance. So those are a few ideas about dealing with volatility. We will talk more about these in subsequent videos. That was all for today. Thank you. Bye-bye. Good night.